All right, today we are going to play financial detective. We're going to look at a company that, from the outside, just looked like a really cheap tech stock. But as we're about to find out, its price tells a much bigger story. A story about an obsolete business, some really complex financial moves, and what looks like a trap for investors who weren't paying close attention. Welcome to the anatomy of a stock collapse.
This number, this is our first clue. This is how much the stock of a company called Hitek Global, ticker HKIT, dropped. Not in a year, not in a month, but in a single day back on March 4th, 2026. I mean, that is just a brutal, catastrophic collapse. So how on earth does that happen, right? That's the big mystery we're here to solve together. What forces came together to cause such a massive wipeout? Let's follow the trail of evidence, starting with the most obvious clue of all. Okay, so the first piece of this puzzle isn't buried in some super complicated financial report. It's actually the company's main business. Like, what did Hitek Global even do to make money? And here it is. This is the moment of impact. See, HKIT's main gig was selling physical hardware for the Chinese tax system. We're talking special printers, tax disks, that kind of thing. But then the government stepped in and mandated a nationwide switch to a free, totally digital e-invoicing system. Just like that, their main product was basically made obsolete by a government rule. And you can see the damage right here. The numbers do not lie. I mean, just look at that revenue cliff. They go from over $6 million in 2022 to less than $3 million just 2 years later. The company's engine was completely shutting down. But as we're about to see, this was only half the story. You know, an obsolete business model explains a slow bleed, right? It doesn't really explain a 34% crash in one day. For that, we've got to dig deeper into the company's financing, into a mechanism that some analysts were calling a trap. So, to really get what happens next, you have to know this term, toxic financing. Basically, it's when a struggling company needs cash, so it issues a ton of new shares. The catch is, the terms of these deals often benefit the financiers, but absolutely crush existing shareholders by flooding the market with cheap stock. It can send the price into what they call a death spiral. And listen to this quote from an institutional research report. It is chilling. It paints this picture of a trap that was set on purpose. The view from the big money players wasn't that HKIT was just a struggling company. It was a slaughterhouse, engineered to take advantage of everyday investors who only saw a cheap stock price. So how did they allegedly build this trap? This is the alleged smoking gun. Here's how it worked. First, the company gives financiers the right to buy stock super cheap. But, and this is the sneaky part, they add a rule that no single financier could own more than 9.99% of the company. Why that specific number? Because if you own over 10%, you're an insider and you have to publicly report when you sell shares. By staying just under that limit, these financiers could, in theory, sell huge amounts of stock day after day, pushing the price down without anyone in the public market knowing who was doing all the selling. Okay, that is a powerful and frankly terrifying story. A hidden selling machine just designed to crush a stock. But any good detective knows you always verify your sources. So let's go straight to the company's official SEC filings and see if they actually back this up, or if there's another twist in this story. So the huge claim from that report is this. HKIT isn't really a tech company anymore. It's just a vehicle for creating and selling new shares, what they call hyper-dilution. So let's put that theory to the test against the company's own documents. And this is where things get really fascinating, because when you actually look at the filings, you see that 2 huge financing programs, we're talking $100 million each, were either canceled or never even used. And even more surprising, the company was sitting on over $37 million in cash. For a company burning only about $57,000 a month, that is a lot of money. So what gives? What's the real story? Was that whole slaughterhouse theory just wrong? Well, not exactly. The truth seems to be a little more subtle. See, having all that cash doesn't disprove the trap. It could easily be the result of previous share sales. And those financing agreements that were never used, they're like a loaded gun sitting on the table. The market wasn't just reacting to what was happening, but to the threat of what could happen next. So let's just recap what we know for sure. Fact 1, the core business is dead. Fact 2, the company did do a massive share sale in 2024, so we know they've done this before.
Fact 3, that whole 9.99% blocker rule, it's real, it's documented. And fact 4, which ties it all together. They have cash, but their history shows they are willing to crush shareholder value to get it, and they have all the tools in place to do it again, quietly. So with all this evidence on the table, a dead business, a shady financing history, and a stock price in the basement, what happens now? Well, we can actually use the data to figure out the most probable future for HKIT. And to understand that next move, you need to know about something called a reverse stock split. It's pretty simple. When a stock's price falls below $1, the exchange, like the Nasdaq, threatens to kick it off. So a company will do a reverse split. It's kind of like a cosmetic fix. They basically staple, say, 10, 50-cent shares together to make one new $5 share. The value is the same, but the price per share is higher. And this table here breaks down the odds. You've got the bull case, some miracle bounce which has a tiny 10% chance. Then you have the bear case, where it all just collapses and gets delisted, a 25% chance. But look at that base case with a whopping 65% probability. Management does a reverse stock split to stay on the Nasdaq. It's just the most logical and most likely path forward. And here's the bottom line. With the stock below that $1 minimum, a reverse split isn't just a possibility. It's almost a mathematical certainty if the company wants to stay listed. And, historically speaking, that's rarely good news for the people who already own the stock. So after digging through all the reports, all the filings, what's the big lesson from the collapse of HKIT? What can we learn from this one company's story that we can apply to pretty much any investment? It all comes down to this one critical question. And I think the story of HKIT gives us the answer. A cheap stock isn't a bargain when the business itself is broken and the financial structure is set up against you. The price you see on the screen, it's just one number. The real story, the one that tells you if you found a diamond in the rough or you've just walked into a trap, is almost always hidden away in the filings. You just have to know where to look.